Good morning, everyone, and welcome to our seminar on currency payment risk management. My name is Graham Catlett, and I am a former member of the Arkansas Economic Development Commission and a former chairman of the Arkansas District Export Council. And we welcome you to this third in a series of 4 webinars. Today, we've got an outstanding speaker, and I'll introduce him in just a minute, but let me first identify the sponsors for today's seminar. First, it is the Arkansas Manufacturing Solutions, which is a department of the Arkansas Economic Development Commission, and we're very pleased for the support that the AEDC gives us for providing these educational programs, both in webinar and in person throughout the state. And also the Arkansas District Export Council, which emphasizes educational programs to help reduce the fear factor in exports. Our ultimate objective, of course, is to create jobs. Today, we have a particular expert on the field in the field of risk management. His name is Mark Ridley, and he is co-founder and director of Greenshoots FX. And let me mention that at the end of his presentation, he will be glad to take questions, and you can enter your questions in the place on your control panel for questions, and we'll get to as many of those as possible. Let me tell you a little bit about Mark. Mark began his career at NatWest Bank in London in 1991. Since then, he has held various transaction banking roles at global financial institutions, including Nordea, Wells Fargo, JP Morgan, and Deutsche Bank. Most recently, Mark worked for BNY Mellon as the North American Regional Head of Treasury Services. Mark is partnered with an array of clients, providing them with the global FX payment solutions that best meets their needs. Clients include corporations of various sizes and industries, as well as banks, credit unions, broker-dealers, asset managers, and insurance companies. Mark is a firm believer in the valuable role that community financial institutions and small to mid-cap businesses play in their local economies. He co-created Greenshoots FX specifically to offer these organizations a fresh approach to international payments, one that delivers competitive pricing, ease of use, and greater transparency. In 2015, Mark and his family moved permanently to the U.S., settling south of Boston, and became a U.S. citizen in 2018. So I look forward myself, as I'm sure you do, to hearing Mark's discussion on payment risk management. Mark?
Thanks very much, Graham. Appreciate the kind introduction. If you're okay with it, I'm gonna jump straight in. I'm just gonna share my screen now. And then I'm hopefully going to expand that. You can't see the full screen, can you? Or can you?
We see the full screen with all your slides.
Okay, excellent. Okay, there's no borders, right? I just want to make sure it is the actual full screen. What I'm going to do as well, because I think my face is probably somewhere on there. Hold on 1 second. Is that better?
There you go. That's better.
Okay. I'm just going to go back to the beginning there as well. Should have been on that one. I'm also going to, I'm just going to turn off my camera just so that my face is not blocking any of the information. All right. So again, Graham, thanks very much for the kind introduction. It's a little bit like I wrote that introduction myself. But if you're okay with it, in the essence of time, I'll dive straight in. Although I will say that I often speak quite fast, and you can probably hear that I'm actually not a native of the US, and that was kind of referenced just then anyway, but my accent is not always easy to understand. So if you do need me to slow down, then please do let me know in the chat function. And I'll also caveat this presentation as being a little bit more, well, it's highly geared towards North American businesses rather than banks. But if there are bankers that are on the call or that are viewing this after the fact, then hopefully they'll still get something out of it anyway. And also probably lastly and incredibly unprofessionally, I do have to declare that I have a 15-month-old puppy in my home office, and I'm hoping that he's going to be quiet for the duration of this this presentation. Right, let's begin. Let's see if we can move forward one. There we go. Right, so foreign exchange rates. I want to start with how key they are, and we think that they are key to how a business's net profit performs. And it doesn't matter if you're invoicing in or being invoiced in dollars or a foreign currency. It doesn't matter. Foreign exchange rates are still going to have an impact on you. And even if you don't have any international business, foreign exchange rates can still affect you as a company. So it does pay attention to them, or at least work with a partner who is willing to pay attention to them, and any event in the market globally, locally, that can be an influence. Exchange rates, they are important, and they do play a vital role in a country's level of trade, which is critical to pretty much almost every free market economy in the world. And for this reason, exchange rates are among the most watched, analysed, and in some cases governmentally manipulated economic measures. On this slide, we've listed just a few examples of influences that we want to talk to. So firstly, as we should expect, governments can control or influence through a number of different means. Monetary policy, and thus changes in interest rates, affect the currency value and the exchange rate. And FX rates, interest rates, and inflation, they're all correlated, and increases in interest rates will often cause a country's currency to appreciate, given a higher interest rate attracts more foreign capital, foreign investment. And foreign investors will often look for stable countries with a strong economic performance in which to invest their capital. And the result of this, drawing investment funds away from other countries and therefore other currencies. And I want to delve into quantitative easing and tapering just for a minute, only because this could be considered relevant for the current time. So the Fed made it clear last October that tapering, which is the act of reducing their monthly purchases of government treasuries and mortgage-backed bonds, and that previously stood at about 120 billion bucks per month, and that would begin in November, given that they believed the economy had recovered to a place that this accommodation could begin. And the issue, though, behind the size and the frequency of tapering is inflation. Recent CPI figures were around 9.7%, creeping up steadily from 5.4% year on year only a few short months ago. And these key gauges continue to keep those that are worried about long-term inflation still worried about long-term inflation. And although PPI numbers have provided a bit of relief, we can't discount the cost of gas at the pump, the increase in food prices, and the logistics issues that we're all experiencing here in the US. And if we then add in the $3.5 trillion portion of the Build Back Better plan, the long-term inflation scenario, it doesn't look too rosy. And the market knew that once tapering began, it would likely be followed by several months or maybe quarters of purchase reductions. And during this time, it should provide enough data to the Fed to determine when they might be able to increase interest rates. And most financial firms today are suggesting 3 rate hikes this year. Goldman Sachs analysts are suggesting there could be 4 interest rate hikes this year. The expectation of tapering was always going to result in a higher interest rate, which theoretically should strengthen the dollar. But bear in mind that markets are forward-looking. So the dollar has gotten stronger over the last year because of some influence of an expected rate rise. Another government intervention is exchange regime setting, which is similar to monetary policy. This is where a country might agree to peg or decouple their currency with the dollar. They may fix the rate, which can be seen with countries such as the Bahamas and Barbados, Cayman Islands, each having 1-to-1 with the US dollar, or further afield with Qatar in the Middle East, where the real is fixed at 3.64 to the dollar. Or maybe they create a linked exchange rate system. And those of you transacting with Hong Kong will notice that the rate operates always between 7.75 and 7.85 Hong Kong dollars to the US dollar. And there may also be some currency intervention. Israel, for example, they have been buying dollars and selling the shekel for the past decade in order to prevent a stronger shekel, which would hurt their exporters, and they're very much an exporting nation. COVID, as I'm sure you're aware, has significantly impacted foreign exchange rates. If we look at March and April of 2020, the dollar euro dipped below 1.10, and by the end of the year was back up above 1.22. Right now, if I look at my screens, we're at about 1.1472-ish. And this significant fluctuation from 123 at the beginning of 2021, beginning of last year, down to 1.12, back up to 1.22, down to 1.5. It's been driven by a perceived expectation on how fast or slow an economy is handling the pandemic. And the FOMC did expect that 2020 GDP would probably fall by about 6.5%, and in actual fact only fell by 2.3%. And then the last 4 quarters, there's been a rapid rise. Changes in government. On Boris Johnson's first day as Prime Minister, he expressed a confidence in a new and a better deal with regard to Brexit, and that caused the pound to jump significantly. And then when Trump was elected president, the dollar rose across the board, hitting a 4-month high at that point in time. Algorithmic trading, fund managers, hedge funds and others that have sell or buy orders sitting out there to execute at a specific price, which could be at a resistance or a support level. So when the market rate hits one of those levels, the algo kicks in, and then billions of dollars are traded at that point in time, and that moves the price. And then, of course, we have other influences which include, but I'm not going to limit them. So stock markets, commodity prices. If you transact with Canada, for example, then movements in oil prices are definitely going to be of interest to you, as the Canadian dollar often tracks with oil prices. Terrorist attacks, scandals, inflation, adjustments in regulations on particular sectors or industries, they're all examples of what can move exchange rates. Okay, so these next couple of slides actually may resonate with some of you. There's a few common challenges that businesses face with foreign exchange, and what we generally hear is there's a lack of visibility. More often than not, this relates to the margin or the markup that's applied to the foreign exchange rate. There's also the components that go to make up the margin that are not always clear, such as payment fees, taxes, intermediary bank fees, and of course the profit that the bank wishes to have. And we've also seen a number of examples where businesses don't actually know what the actual exchange rate is until they see the dollar value posted on their account the next business day. So with no visibility to the rate, at least, it's obviously something that can't be challenged. You can't negotiate it, and you can't reject it. No information, specifically no information regarding best practices for global payments. A good example is maybe you're not being approached by your payment provider to discuss why sending dollars to global vendors can often result in overpayment. And we'll go into that in a little more detail in a later slide. But often there's a lack of FX commentary that allows businesses to make informative decisions on whether to buy or sell a specific currency. And when does it look best to do this? It's imperative that you work with a partner who can provide that advice and guidance on where currencies could be moving, and to explain the reasons and maybe show data that support those comments in a very nice, clear and easy to understand way. Wide margins, that's the most common that we really do hear of. Those savvy enough maybe to Google the foreign exchange rate that they've just been offered can probably tell whether the markup is high, or maybe, or can they? They could determine roughly what the margin is at least, but how do you know whether it's still good or bad? And businesses are generally unaware of what's out there. Like, you don't know what you don't know, and often it's thought of that a bank, for example, is the only or the safest option. But are you getting the advice and guidance on best practices? How would you actually know you're getting sufficient guidance? So ask yourself, like, are you being offered risk management tools to help you protect your company and its bottom line? Do you have regular conversations with your payment provider to ensure that you're current with what's taking place in the market? And do they know your payment flows? Do they know what they look like for the next 12 rolling months, such that they can provide right level of support for your cash flow planning? And are they aware what countries you're paying, so that they can at least opine on best practices for settlement? For example, payments to Hungary are often best made in euro and not in foreign. Paying euro via SEPA Instant, which is a payment rail in euro, instead of Target 2, which is another payment rail, is another example, notwithstanding that there are limits to certain global payment settlement rails. Importers and exporters commonly say, so when we ask the question, do you have foreign currency exposure? The responses are most often, we're invoiced in, or we invoice in dollars, and therefore we don't have any FX exposure. Well, firstly, if you're invoiced in dollars, then you could be overpaying, as I mentioned on the previous slide, and you most certainly actually have foreign exchange risk. And I'll go into that in a bit more detail on how and why shortly. I assume I receive great rates. This one often makes me smile. Well, how do you know you're getting a great rate? What are you benchmarking them against? Were you getting great rates at the beginning of the relationship? And have you paid attention to whether those margins have slowly increased over the course of time? There are tools available that will retrospectively show you the margin on each and every trade that you've undertaken. So you can see whether the margins that were promised have been adhered to, or if the margins were never declared, you can at least see how it arbitrarily increases and decreases, or maybe remains inflated. I don't have time to learn FX, or a variation of that comment. It's not your responsibility to know as much as an FX trader, though naturally you need to have some understanding of the contracts that you're getting into. One example that we have is where a company was buying some technology from India, and had asked for a price in dollars and was quoted about $500,000, if I remember rightly. And during our conversation, we suggested to the owner that paying in rupee could probably result in them paying about $470,000, and thus then saving them about 30 grand on just that one transaction. And the business owner said that if he spent time learning foreign exchange, he might miss an opportunity for his own business, and therefore the opportunity cost of missing out on a sale could be greater than $30,000. And my flippant British humor, I kind of replied that if he can make 30 grand in about 6 minutes, then I'm in the wrong game. So selecting the right partner means that you'll at least have an expert strategist in your corner that's watching the markets for you, ready to make suggestions on whether to buy, to sell, or even wait when rates might be taking a turn in either direction. Risk management tools, what are they? Where are they? Some regional institutions regretfully don't have them. Some larger banks have them, but don't always offer them. A natural hedge, that's the reduction in risk that can arise from your normal operating procedure. So maybe you have payables and receivables in the same currency. So when suppliers, production and customers are all operating in a different currency, larger companies may look to source raw materials and components and other production inputs in the final consumer's country, so that the business can then set costs and prices in the same currency. So you might have a factory in Croatia, but most of your sales could be in Euroland. So does it make sense to then maybe move production to, say, Lithuania? Excuse me. A forward FX transaction, which is a binding contract where you can fix your foreign exchange rate today, obliging you to settle on a fixed date in the future. And that allows you to still have the cash free for other uses in the meantime. And if you have a good idea of what your next 24 months of sales and purchases look like, you could enter into a hedge for each month out that far. And then it gives you a known dollar value for your cash flow forecast and protects you from a worsening exchange rate. But a caveat there, or not a caveat so much, but as a gentle reminder, a forward FX rate is not a prediction of where the rate will be. I personally liken a forward FX transaction to that of a fixed rate mortgage. Like in the UK, it's rare for us to lock in a mortgage rate for 20 or 30 years like we do here in the States. And we do so here because we, A, want to know what our financial obligation will be at any point in the future, as well as B, protecting ourselves in a rate rising environment, i.e. protecting us from the downside. And that's what a forward FX transaction can do in the currency markets. A window forward, however, we don't see these so much in Europe. They're widely used here in the US. It's useful if an importer or an exporter is having difficulty in estimating the future settlement date of payables or receivables. They're broadly based on the same principle as as a fixed dated forward, but it allows for settlement between two dates, i.e. a window in the future. So if you're an exporter and expect 500,000 euros mid-March, you might have some concerns whether you're going to be paid on that exact date. I mean, given that we're still in a pandemic situation, given that the supply chain is still massively screwed up, you might be expecting the receipt of those funds on March the 15th, but realistically it's probably going to arrive after that. So you might buy a window forward or enter into a window forward that could be from, say, March 15th out to June 15th. And provided you receive the 500,000 euros into your account within that time period, you will get the rate that was agreed today. So again, you can still have a good idea of the US dollar value that you're going to receive, despite not knowing exactly the date that you will receive the funds. And as an FYI, forward rates, they're actually determined by the interest rate differential in each of the paying and the receiving country. So with relatively similar interest rates at this point in time, it's likely that the forward rate for euro dollar, for example, is not that much different from spot rate. And just looking over at my screens right now, that seems to be the case. Excuse me. Market orders, they're great if you have the time to wait for a specific price, or if you want to avoid losing out if the rate moves against you, which could happen without your knowledge. So for example, you might have a euro invoice that's due to be paid in, say, 90 days. And as a nice to have, you'd like to buy euro at 1.14, but also you don't want to get caught unawares. And so you decide to set the stop loss at 1.16 at the same time. And you can often stipulate an expiry date, or you can leave it open-ended. And if the rate is achieved outside of the market hours, then that trade is executed, and the other is automatically cancelled. So actually, while it's great protection out of hours, it's actually a benefit for you during your working hours too, because it means you don't have to sit watching the rate all day, and you can go about your regular business safe in the knowledge that you won't miss out or lose out when the rates change. And the most straightforward of FX risk management tools are currency accounts. And they are a simple way to prevent a volatile market from eating into your profits. Importers, if you have the liquidity and the rate is in your favor, you could purchase your currency today and you can store it in your currency account, and you can use that obviously whenever the need arises. And if you're an exporter and you've tried to open accounts overseas, you'll appreciate this is not an easy task. It can be expensive, especially if your payment volume is small. And so the most practical solution is to hold your currency accounts here in the US all under one roof. You can receive currencies easily from your global sales. You can hold on to them until the rate improves, and then you're naturally going to convert to US dollars, or for that matter, to any other currency. Your counterparty risk is also then transferred to your US institution, so you no longer have country risk to worry about either. And options, an option gives you the right but not the obligation to buy or sell at a specific rate on or before a set date. There is a premium charged on currency options, which can be high, and the cost will always depend on the strike price and the execution date. One reason why you might use an option and not a forward transaction could be the probability of the underlying transaction taking place. So for example, you might be a company looking to acquire an international business, and that may not necessarily come to fruition. And if you have a fixed forward or even a window forward, you still have that obligation to settle. Whereas under the option, you can just let that lapse and walk away from the transaction. Now, I spoke earlier of businesses not knowing what they don't know, and one such area of not adhering to best practices is where importers think that paying global vendors in dollars makes the most sense. And indeed, there are times when this is either necessary or it might only be the only option. China's a good example of where exporters most often prefer to be paid in dollars, not only because of its stability versus the yuan, but because they have expenses in US dollars and are looking to create that natural hedge that we discussed earlier. But in many cases, invoices may be padded, which is to say that they are inflated and often by 5 to 7%, sometimes higher. And this is because the exporter is bearing the exchange rate risk and may not have access to or knowledge of risk management tools. So it's highly likely they don't want dollars, given that they're paying their employees, their utilities, their loan interest, and yada, 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 and so on in their own currency. So question, is paying in dollars something to be concerned about? Well, at the very least, it should be investigated whether it does make sense to switch to paying in the currency of your global vendor. But whether you're overpaying or not, you could still have foreign exchange risk anyway, and this is usually a head scratcher. We'll often ask businesses to look at an invoice that they paid in, say, March of 2020, right? The start of the pandemic, versus say last summer. So mid-March 2020, at that beginning, the dollar pound hit 1.1650, so 116.50, and then during the summer, the dollar had weakened to 142.20. So bear with me here, right? So if a UK seller wanted £100,000 for their pallet of widgets at today's rate, that's an invoice to you of about 138,000 bucks. That same pallet invoiced in March of 2020 could have cost you 119,000 bucks. Now, if the US buyer, if you don't see much difference when you compare those two invoices, it could be because the seller is using the forward market, or maybe they are taking the loss. Because if they were to constantly invoice $119,000 each month, then today, without that hedge, they're going to be receiving in the region of about £85,000, so £15,000 less than they used to receive at some point in the past, and they're not going to be able to continue taking or absorbing that loss. So essentially, you have FX risk. You can't see it, and therefore you can't manage it. And I'm sure you've heard this 100 times already. Asking a vendor for a dual invoice is common practice in Europe. So when negotiating the price in dollars, you should ask for a price in their currency, in your vendor's currency as well. And this often removes the padded amount. And if your FX provider can offer excellent margins, then the cost saving can be greater still. So hopefully also your global vendor may appreciate the fact that the FX risk has been removed from them, and that could also drive a better price for you. And for you exporters out there, if you quote to your international prospects, and I'm not saying clients, I'm specifically focusing on prospects. If you're quoting in dollars, you may become uncompetitive. And if your German buyer, for example, receives 5 bids, 4 of which are in euro and yours in dollars, if they don't discount it altogether, they're at least going to park it for the moment, because you're giving them the foreign exchange risk, and they may not have the means to manage it. So we met, a good example is, we met a CFO who said, well, yeah, thanks, Mark, but we're the only manufacturer of this product. To which my response was, yeah, that's fantastic, that's wonderful, and that's a unique position to be in. And so for all intents and purposes, you could invoice them in Hungarian luncheon vouchers. But it isn't the purpose, but isn't it the purpose to expedite the sale? So invoicing them in dollars means that they have to go away, they have to figure out the true cost to them, they have to maybe make calls to their bank, figure out whether they can enter into a forward contract, that they even know a forward contract exists. Maybe they can, maybe they can't, but bidding in their currency means that they can immediately understand the true cost, and they can also make a faster decision to buy. No surprise that a CFO and a salesperson have different agendas. The CFO, after all, is managing risk, managing cash flow. They're keen to make sure that financial obligations are met on time, and have many other responsibilities. And in order to achieve their goal, they need an accurate cash flow forecast. So invoicing in dollars seems like a logical thing to do. I mean, after all, it's a currency they understand with a value they can use in their planning process. The salesperson, on the other hand, they want to make the sale, and to do this, they need to be competitive on price. So if they could invoice or quote in the currency of the buyer, and in doing so use aggressive foreign exchange rates, it increases that probability of success. How is that? Well, if you were to bid $140,000 to your UK buyer on a 60-day term, that could cost them about £104,000, give or take, if they were to lock in a forward foreign exchange rate today with their payment provider. But if you can access low margin on your foreign exchange rates, you could enter into a window forward and offer the buyer maybe £102,000. So a price in their currency less than they'll pay via their payment provider's FX capability. And in doing so, you'll probably receive a little over £140,000 anyway. So you're removing the foreign exchange risk from the prospect, quoting a lower price to your prospect in a currency they can easily plan for, and you're increasing the likelihood of the sale as well. Plus the fact you're expediting the decision time to buy, and if you're lucky, you might even pick up a few extra bucks. Equally, if you're invoicing existing clients today in dollars, you could switch to their currency and invoice them what you believe they're paying today in their local currency, or maybe have a grown-up conversation with them and see if they'll tell you what they paid from their bank. And maybe using tighter margins on your FX, you can either A, lower their price paid, maybe B, quote them the usual price they pay, or C, have it in such a way that they pay less for their currency and you collect slightly more dollars. Regardless, I'm sure they're going to thank you for removing the FX risk from them anyway. But whether you're managing this process with prospects or new clients, just as we discussed on the important side, you can offer your clients two prices. One is US dollars and the other in their currency. And as for the risks of invoicing in US dollars in a strengthening dollar environment, a buyer who hasn't hedged will have to pay more in their currency when the payment falls due. And if they're buying on 30, 60 or 90-day terms from you, there's an increased risk of by default, which to be honest, you might not worry about if you've purchased insurance from your foreign receivables. And if you're listening into Brent Hoops later on, he'll go into a bit more detail about that. But regretfully, we were in a period of a strong dollar, so it's not so great for exporters, although marvelous for you importers out there. We might, if you're looking at the rates today, you'll see probably a slight switch in that attitude. Okay, my apologies. Okay, so I thought I had an extra slide in there. I was just looking around for it. So foreign exchange payments companies versus banks. I'd just like to look at a quick comparison. And I'll firstly say that we're not bank bashers, quite the contrary, in fact. Banks are massively important. They warehouse our hard-earned salaries and offer us an array of products and services, from insurance to investments, business loans, credit cards, whatever it might be, merchant services. And so they can often be a one-stop shop. And you may get a significant sense of protection from a bank, and if peace of mind is what you're after to help you sleep, then so be it. But often there can be some key differences though between a bank and a dedicated payments company, and these are merely my own personal observations, having spent a few decades in the industry with 7 banks on a couple of different continents. The bank relationship manager I've found is often a generalist, and so they're selling multiple products, and in many cases they could even be a loan officer, and they'll typically gravitate towards the higher margin products that they know incredibly well. And there are many positive attributes that your relationship manager will have, but positioning certain foreign exchange tools and watching the currency markets are likely not part of their job description. Foreign exchange rates provided by banks are not always live rates, and many branches will instead quote from a daily fixed rate sheet with what will be typically wide margins, and they have to be wide because the rate is applicable for the whole day. So asking if it is a live rate versus a static rate and then comparing that to your Google research could be a way forward. Risk management tools are not always available. I referenced that earlier. And if they are, does your contact know that their institution can offer them? And can they talk to them confidently? Or at least can they get you in touch with somebody within the institution that can help you out there? Smaller regional and community banks, they often use a larger US bank who are responsible for providing the FX rate to them, as well as the payment infrastructure. And that could also be a high markup at that point, which then the regional bank will add their margin to. And so this is an added layer which can often result in the underlying business receiving a not so great exchange rate. And your FX payments partner, excuse me, on the other hand, should be offering an online, easy to use platform with those live foreign exchange rates, as I just referenced, for at least maybe the top 30, 50 trading currencies that with the US, and then also providing regular advice and guidance on the best practices and offering risk management tools to protect and at least boost your bottom line. And maybe a contact that will reach out to you when the currency that you're interested in is moving in a particular direction. Supply chain partners, I like to include this one. So aside from making sure that you have a solid global payments partner, it probably pays also to review other segments of your supply chain as well. There are a couple of comments that drive me nuts the most, so if you ever do speak to me, please don't use them. But that's the way we've always done it. And so we encourage any businesses to make time just to take a temperature check, with your incumbent providers, just to make sure that they're up to date on best practices and with what developments that may be taking place to help you mitigate risk and expedite transactions and maybe even reduce costs. The Export-Import Bank of the United States, you're going to hear a bit more about that in the next session. That's a government agency that's going to offer programs such as trade credit insurance. Again, Brent will be speaking about that later, and political risk insurance as well. And this allows exporters to have in the region of about 90% of their invoiced amount insured against non-payment for literally cents on the dollar. And now you have a foreign receivable backed by a government guarantee, which you can finance, whereas before you couldn't. And if you're an exporter, continually butting up against your foreign receivable credit limit, the Exim Banks, it's a good way to help you break through that and potentially boost sales. And surprisingly, I believe the number of exporters using the Exim Bank is about 7%, whereas I think it's about 70% of exporters in the UK are using the ECGD, which is the Exim Bank equivalent. But I'll say no more on that because I don't want to steal Brent's thunder. Foreign trade zones are secure designated locations around the US within about 60 miles of a customs port of entry. Among other benefits, they'll assist in reducing import duties. They'll offer duty exemptions on re-exports and duty elimination on waste and scrap. Logistics are also streamlined, where upon arrival from customs, imports may be directly delivered to the zone. So you may not necessarily even have to create a new FTZ in order to close to your plant or your factory, because there could already be one in existence within a reasonable distance that you might be able to operate out of. A good customs broker can ensure for definite that you're classifying your imports and your exports, for that matter, correctly to further ensure you're paying the correct duty. You don't want to underpay, of course, but you could also be paying too much. And they'll be equipped with proper licenses for the areas that they operate in, and they'll keep you up to date on all necessary requirements. Freight forwarders, some of which have customs broker capabilities. Are you utilizing the best routes, the best modes of transport, and the correct or most cost-efficient Incoterms? If you mention to a freight forwarder that you import DDP, for example, you can probably expect them to roll their eyes, because it's not unusual for exporters to profit from those types of arrangements. So you should expect your freight forwarder to at least show you the benefits of other Incoterms. And then check in with a compliance expert once in a while and truly understand if you are using supply chain best practices. And there is, as you know, or there are, should I say, other parties to consider reviewing too, and other support professionals that can give you a guidance. And I'm immediately thinking of letters of credit experts, one of which I was speaking to yesterday, which is why this is top of mind. Factoring companies as well, the latter of which often seems to carry a stigma here in the US. I don't understand that. It used to be that way in the UK 20, 25 years ago, but they seem to be widely used. Before I come to the in summary, there was I do apologize, there was a slide that I wanted to have included in here, and it was touching on some things that might have been of interest. So I'll just talk to it if that's okay. So with Amazon, UPS and companies like that, we're able to track and trace where our packages are, and we can see more often than not, like how many stops they are even from our house, and probably, or not probably, but definitely the date and the time which they pass through various places. So shouldn't it make sense that we can track and trace exactly where our payments are? Now, the highest level of queries that are raised within a bank is beneficiary claims non-receipt, and that translates to where is my payment? And for those of you who are working within a business, you may not be aware specifically of SWIFT, which is a global messaging system that allows banks to talk to each other in a secure environment. And the most common of SWIFT's traffic is the payment related messaging. And yeah, it took 40 something years after the launch of SWIFT for the introduction of GPI, which you might have heard of. And that's the Global Payment Initiative. And that's what allows for payments that are sent across the global network to be traceable and also with full transparency. So, excuse me, on the basis that the payment instructions are all routed via banks on the SWIFT network, you'll be able to see which intermediary banks it was routed through, the dates and the times, and who touched it, and what deductions were taken. And therefore, if your beneficiary does claim non-receipt and your institution offers you GPI, you can investigate very quickly when and where and how much was credited to the end account and under what reference number. Now, I say how much because often the cause of claiming that funds were not received is a reconciliation issue where the beneficiary received less than they expected and therefore weren't aware of the credit actually having posted to their account. And that leads me nicely to lifting fees. And these are the deductions that banks take from payments as it moves from one institution to another. And regretfully, financial institutions are not for profit, and as such, understandably, won't process the payment for free. But check with your payment provider to ensure that they're not taking any deductions from the payment before they send it on to the next bank in the payment chain, which would seem unethical given that they've probably charged you a wire fee for the transaction already. But it's not unheard of that an institution might charge a fee and take a deduction at the same time. So just be sure to check that out. In order to mitigate deductions though, by the beneficiary bank and also any of the intermediary banks, you can send the international wire and stipulate that you will cover the charges. And as such, each bank that processes the payment in full and will claim back their fee from the remitter, i.e. that's you. And that can be costly, especially if you're paying to somewhere like Japan, for example, and other countries who prefer to charge on a per mil basis. That being said, payments to the EU and the EEA, that should not attract any deductions by the beneficiary bank under what is known as the Payment Services Directive, or PSD2. Faster payment schemes, there's approximately 56 countries around the world that have an instant payment network, which are designed to move funds within seconds between accounts at different banks. And I bring up faster payments, or instant payments as they're known, because keeping yourself up to date with the payment clearing systems and the practices of the countries that you're paying to could help you lower your costs with your payment provider if they have access to correspondents who participate in those local schemes. So hopefully, and I'm keeping my fingers crossed, hopefully you already offered a two-tier pricing, depending on whether the payment is sent via a wire equivalent, that is to say settlement in the foreign currencies via what is colloquially known as a high value clearing rail, i.e. the equivalent of Fedwire here in the States, or via the faster payment rail, which is a cheaper settlement process and often has a faster settlement time too. Therefore, if you happen to be sending thousands of transactions a year, there's an opportunity to reduce your fee expense. And updating beneficiaries is important. One of the most effective ways to ensure that your funds arrive at the correct beneficiary in a timely fashion is to always ensure that the correct beneficiary information is provided for each transaction. Attempts to defraud organizations are on the rise across the markets and industries, and fraudsters are thinking of more and more creative and highly sophisticated ways of redirecting payments. They certainly try to exploit weaknesses in legitimate beneficiary change requests. So that might include forging a company letterhead to submit requests and or posing maybe as a new account manager. So learning to recognize the red flags and establishing some strong internal protocols that's definitely going to go a long way to protecting your funds and your business. And that's why maintaining an updated beneficiary contact information and bank account numbers are imperative to securing your funds. So it's recommended that you at least contact or connect with known and trusted contacts at your vendor and verify beneficiary information regularly in case anything has changed. So I apologize that I've just talked to a slide that wasn't included in the pack. So in summary, many businesses are at a place, especially now, like where every penny counts, and where risks that exist and are being ignored, they do need to be addressed. So to summarize, I'd say if you're paying global vendors in dollars, give some thought to switching to paying in a currency, because you could be overpaying, as well as having that foreign exchange risk that we talked about earlier that you just can't see and so can't manage. Products and services, they do exist and they should be available to you, and they include anything from online live foreign exchange rates that's going to make it more convenient for you to at least get a rate, risk management tools such as the forwards and market orders, and at a basic level currency accounts that are all designed to protect you from the downside. FX rates are constantly changing from when the market opens, and that's at 5 p.m. Eastern on a Sunday, and that operates through to 5 p.m. Eastern on a Friday. So they're operating 24/5. So give thought to working with a partner who's going to understand your cash flow, your global payment flow, the currencies that are of interest to you, so that you can just get news and information on what's happening with the currency, and a team that will provide information on currency movements that will, or could impact you. And there really are some simple changes that you can implement in order to protect your company and the bottom line. And there might be some misconception that foreign currency products are confusing, and that changes to your behavior are going to eat into your time, and neither of those are true. And finally, just taking 15 minutes out of your year can make a huge difference. Like, so if you have a headache, you don't go and see a mechanic, well, unless your mechanic also happens to be your primary care provider, but if they are, that's a different story, I suppose. But the point is, like, you go and see a specialist, and that should apply to your supply chain needs too. And with that, and if you're still awake, I'm definitely happy to field some questions, and any that I can't answer, we'll make sure that I get back to you through your hosts. And if anybody's watching this after the fact, feel free to either email our colleagues here, or you can connect to me directly.
Thank you very much, Mark. That was a very comprehensive and helpful discussion. We do have a few minutes and we don't have any questions yet. So if anyone has a question, please enter it in your control panel. In the meantime, let me ask, are there any thresholds that you'd recommend for a company to have in order to consider foreign exchange, whether it's a transaction size or an annual amount of export transactions? What do you recommend for a company to consider?
Well, that's a great question, Brian. And there are so many variables at play there. So we've had conversations with companies that turn over billions of dollars, and have said that a $5 million saving in foreign exchange is the equivalent to a chairman's lunch, and there's no need for them to even think about moving. We've had conversations with companies that that might only be paying a couple of $1,000 a month internationally overseas, and like 50 to 100 bucks saving per transaction for them as their startup businesses is more important. So I don't think there's a specific threshold. That'll be something that's unique to each and every institution. But no matter what size you are, like taking time to have those temperature checks, I think makes the most sense. And I understand, I get why businesses tend to not necessarily want to change, because they think it's painful. And it's funny how I beat the drum and say, look, just take 15 minutes to have that conversation, to open up an account and to do something slightly differently shouldn't take longer than X. So I bleat that quite a lot, and more often than not, when I'm standing in the queue at Home Depot and you get somebody who taps you on the shoulder and says, hey, would you like to open up a Home Depot card so you can get a 20% discount today? For years, I've just been waving them away, because my misconception is, well, that's going to take forever. I haven't got the time. I've got my son who's like, got his fingers in many pies. So no, I don't want the card. I don't want the 20% because it's too much of an inconvenience. And then recently, standing in the queue, I had about $500 worth of kit in my basket or on my trolley, and I was asked the question again, and I thought, dude, you can't preach and not practice. So I said, yeah, all right, let's do this. You know what? It was a 5-minute process, and I walked out there hardly any time later, having saved myself $100. So, I think the misconception that changing providers is painful is not there. It used to be, for sure. And I read an article a few years back that said you're more likely to change your partner than you are your bank, because it's easier to get a divorce than it is to open up bank accounts. That was of days of old. And with open banking, like, changing providers and moving money seamlessly from one organization to another is it's really simple, and it's really quick and not so time consuming.
Good. Let me ask a question that's been posed. It says, regarding the 5 to 7% padding on invoices, can you provide an example as to how that padding gets hidden?
Yeah, so you might be, so let's think about that. You might be buying widgets from Germany, and you're asking for a price in US dollars. Now, let's just say that exporter in Germany wants 100,000 euros to meet their margin. So they want 100,000 euros for that pallet of widgets. First thing they're going to do is either Google or maybe just go to their bank, because they're going to look, they just want a theoretical dollar-euro rate. So they're going to go to their bank and say, what's the rate? That bank's going to give them a wide rate. It's not to be used for the actual exchange. It's just for indicative purposes. So they might be given a wide rate. Now, the US exporter is like, right, I need to quote in US dollars. So I'm going to take that rate, which is 114. Which is probably about 116. So that's 160,000 bucks. So that exporter says to itself, I need 160,000 bucks, but you're going to pay me, or my global client, my US importer, is going to pay me in 60 days. I have no clue what the rate is going to be. I don't want to invoice $116 today and find that when I receive $116 in 60 days time, that equates to 95,000 euros. So I need to factor in and build in a buffer. So instead of saying it's going to be 116,000, I'm going to quote 120. And then the US buyer is not aware of all of the mechanics that's going on behind there. All they see is $120,000. They say, I understand dollars, I can afford 120,000. Let's strike the deal. Let's do it. I'll pay you $120,000 in 60 days. Not realizing that if they'd have gone to their financial services provider and said, give me a rate for me to pay 100,000 euros in 60 days, you'd probably end up paying closer to 115,000 bucks for that same transaction. And also, you're fixing your rate today, so you know what your dollar obligation is going to be in 60 days, but you've just paid $5,000 less. Excuse me. That's a pretty typical example, and it's usually 5 to 7% on all values.
Let me ask one final question. You made an excellent point that we may not be maximizing our profit on every transaction because of using US dollars, but how do we incentivize the CFO to agree that there could be more sales if we look at foreign exchange? How
Yeah, that's an excellent question, and that's one where we at Greenshoots FX and pretty much any company that I've worked for, that's where we spend a lot of time banging our heads against a brick wall a little bit. It's very difficult. We did some studies recently about certain demographics and whether you're a baby boomer CFO or whether you're a millennial CFO, and the way that you think slightly differently. And that's why I kind of slipped in the comment earlier on, which is one which I absolutely hate, which is, but that's the way we've always done it. Well, yeah, but the world's moved on, not only since 20 years ago when you started that practice, but this morning when you actually woke up. So yeah, that is a tricky one. That we always find that one to be a tricky one. So but the best way that we find is literally spelling it out in stick figure drawings. So like very simplistic diagrammatic flows, like with live and tangible data that supported it. And then failing that, it's a case of, look, a year is 365 days. Why don't you just take 10 minutes to go and call a reference and see how they're doing it, and see how easy it was to make that switch, and how they can sleep better at night knowing that the risk is appropriately managed, and also they're doing the right thing for their shareholders. More often than not, I might also actually guilt them into making a change by saying that. Do you care about your shareholders or don't you?
Mark,
how to lose friends and alienate people.
Right. Thank you very much for the time that you've given us. I know that the Arkansas companies that listened will be helped by what you said, and hopefully they will eliminate some of the risk that they're already taking, and also some of the fear that they have in foreign exchange and in exporting. So thank you very much. We appreciate the sponsorship of the AEDC and the Arkansas DEC. And this will conclude our program. We have our next program at 10:30 regarding export credit insurance. And so we welcome everyone back at 10:30 for another great speaker. Thank you again.
Thanks very much. I appreciate it, Graham. Thank you.